Happy Saturday, everyone. Welcome to another episode of RM Smart Investing. I hope you all had a wonderful week and getting ready for a long weekend. As you know, it's the second year that we have this Juneteenth, and it is a 3-day holiday, or we have a bank holiday in the United States. So although it's supposed to be on the 19th, which is Sunday, but they're going to observe it on Monday. So be aware of that. The markets will be closed. The banks, the post office, a lot of government agencies are closed. So just a heads up. So we won't have any markets. So I hope you will enjoy. It's a Father's Day tomorrow for all the sons and fathers and anyone in between. I wish you a wonderful Father's Day. And here we are. So today, with the talk of what is happening with the markets, we had an unbelievable week last week with the markets dropping, another big week coming down. You're hearing the pundits now on TV and even some retail investors believing that this might be a good opportunity to start buying the markets. We probably have hit the bottom or very close to the bottom. So my intention for today is really go deep and see, are we pretty close? What's going to happen the rest of the year? And of course, the big news was last week with the Fed's decision. So as always, we touch on that with the economy, with the markets, the emerging markets, as always, the lesson of the week. And that's on the lesson of the week where I will emphasize and go deep in what is happening with our markets. And then we'll have a few trade of the week and ideas for the week, and then screen of the week. So let's start with economy. As always, we like to go under the hood. And initial jobless claims and the continuing jobless claims, they are been just improving. And what is happening again, that's one piece of the puzzle that has kept the glue with this economy. Now, the question is, when we talk about the jobs, and that has been really the intention of the Fed, which is watching, it's been obviously helping to do what Fed is trying to do because of the strength in the labor market. The question is, how truly strong is it, and the effects of the Fed's action, how will affect the whole the jobs and the wages. And I think a few weeks ago I mentioned, we've had a lot of inventory buildup, so there is a chance that there might be some employees let go because of, let's say, like Amazon. We've heard about the retail companies like from the Walmarts and Targets. So what they're going to do. On the other hand, when we look at how many jobs available, there's about 11 million, and how many unemployed, which is about 5.5 million. So there is that strength still in the market. So even if 1 million, 2 million let go, there is still that strength. So far, it's a savior. One thing we want to pay attention, every week we look at the weekly retail sales, and we see this green number, and we say, well, this is much better than when it was in 2019. Well, one of the biggest components of this retail sale is the gasoline. So obviously, the gas stations are doing fantastic because of the price of gasoline, so which is obviously negative. The other thing is like the box office receipts, and it's the summer, and I think last week was the Jurassic Park, I think the last one, they broke all kinds of records. We've had the Top Gun coming back, so it has been pretty good. People are ready to go out. And also the TSA checkpoints and the global commercial flights, you see there's been improvement. And when it's in orange, that means it's the highest we've been since the pandemic started. Now, the question you have to ask, we talked about the leisure and people are really ready to go. So a lot of people made the arrangements, months ago to have these holidays to go on their flights. The question will be going forward, how many people are willing to pay higher airline ticket prices, with the jet fuel up about 12.1% for the month. And, of course, other expenses, how willing they will be. So we shall see. We want to watch this as far as the commercial flights goes. So there's a combination of, again, we still have a healthy consumer at this time, higher prices, they're willing, but there will be a break point. So we want to watch that. So the big news, obviously, last week was the FOMC meeting, the central bankers in the United States and other countries, which we will talk about. They are really determined to combat the inflation. So Chairman Powell came up on Wednesday and somewhat surprised the markets, because in May he was very adamant it will be a 50 basis point, but basically ended up being 75 basis point. Initially, especially during the Q&A, the market reacted positively. And it is important that the Fed is looking at this very seriously. We will, in the lesson of the week, I'm going to have a visit about inflation. We will talk about the resemblance and what is happening between now and 1973. And we talk about 1970. So we'll dive in a little deeper. But right now, as you can see, our Fed rate has come up to 1.50 to 1.75. So we also look at the dot plot, and interesting enough that earlier, the dot plots, which is all the central banks, as far as their consensus, where the Fed rate will be, it was at 1.875. Now, it suggests that it might finish at 3.375, which is another 150 basis point. And what that means is, of course, we have July, and then we have September and on. We will have the question is, would they do a 0.75 or 75 basis point in July again, or would they do 50? And then would they do another 50 in September and then go a quarter? So basically, you can see it's very much rapidly moving. They are become hawkish. They are really, for them, inflation is much important than recession at this time. So they are willing to sacrifice the consumer at this time. And because of that, you could see Thursday, and then what happened, and then Friday, because now that so-called R, the recession, is in the vocabulary of many people. So the other thing is, as far as again, in this case, the Fed think that it will finish at 3%, and then the 2023 will go to 3.625, and then the idea is we might have a quick recession, and then they can actually start declining the rates. Now, the other thing is, and I mentioned they are in a fantasy land last time when they talked about the GDP. They were thinking it's going to be 2.8%. With all the things going on, and with the interest rates affecting all the businesses, they have really changed their forecast. They downgraded to 1.7, which I still think is optimistic, but that's what they are looking at. And it also for 2023, they revised it. So we want to watch that, and also their PCE, personal consumption expenditure, they've gone from 4.3, they've gone to 5.2. Now, the other thing they're thinking, the Fed's inflation forecast for 2023 and 2024 has gone to 0.6 and 2.2%, which is, I don't know how could that happen, because of, things really have to be perfect. And that's what they're hoping to have, the soft landing, which has really, I don't recall in the past has ever happened. So we shall see. Now, I thought this was of importance as well. There was one dissent at today's, what I mean, that was the Wednesday's meeting, Wednesday's meeting, that was from Kansas City Bank President Esther George, that suggested preferred 50 basis point rather than 75 basis point. While we can see how the short-term rates really, shot up. So that's where we stand. We're looking at, again, we're looking at the 5 to 10 year where it was, and now we're getting inversion as far as today. So again, we watched that 2-year, 10-year, and we're watching again that the high yield and the corporate, and we see the spread is widening, and that's again the concern about what's going to happen with the low grade junk bonds, and that's a heads up, a warning about again the slowing economy. So with that in mind, as I mentioned, next week there's really not much economic news coming. There's a housing numbers will come, and basically we got Chairman Powell will be having a Senate hearing next Wednesday and I believe Thursday, Senate and the House hearing. And then we have many of the central bankers around the globe. They will be talking. So I will go over that in our trading ideas for the week, so it could have a little more clarity there. So let's dive in the markets, because that's what's happening. Is that it's in the minds and hearts of many investors. So here we go with the sentiment, and as we shall see, again, we've been like a yo-yo going back and forth between the, bears calming down, and then they're aggressively going back up. This was on Wednesday, and the bulls are really minimal. So it's been, again, a very volatile. There's no really consistency in a way of, just for long-term thinking. This has been very reactionary in my opinion. But again, you can see we've been very much last few weeks, and even for the year, you can see the bears have been ahead of the averages. So we are very close to where we were on April 27th. And the same thing with CNN fear and greed. We're at actually 14. So that's close to where we were last month. And you can see how the markets have been going. So the question we will discuss it, have we seen the capitulation yet? And that's what we need for a real bottom. The question is now, when the pundits and some investors are still buying the dip, I still don't see that. Well, we will discuss it more in details. The market sentiment from the Citigroup is right at 0. It was 0.07, so really just in the neutral kind of zone. So what happened last week? Last week, again, a bloody week, and what Dow Jones went below that magic 30,000. We are at 29,886, 87, down 4.8%. The NASDAQ is down 4.78% for the week. S&P 500 was the weakest, and also the Russell 2000. They were so weak, we were down 5.8%. And one of the biggest things, and we will explain that while we look at the charts, remember the S&P for the last 10 years, when you think about energy sector, it has been such a small portion of S&P, but with the movements that we've had, now they're representing a lot more of S&P. Of course, when we think about S&P, we talk about technology, we talk about financials. But now with the movement in energy and what happened on Friday, it was down almost 11% on the back of a 10% drop on crude oil. That's what really has affected the S&P, and that's the reason they were worse performer than NASDAQ, for instance. Now, gold was down about 1.9%, copper was down 6.5%, and crude oil, as we mentioned, 10%, which we will discuss it more what happened. So for the Dow, we are down almost 19% from the high of January 4th. So we are going into that bear territory. Now, S&P is in the bear territory, down 23%, and NASDAQ has been almost 32%. Now, oil is only down 11% from its March 8 highs, but up 44% from January lows. Again, needless to say, everything has been down for the week between 4 and 7, 8%. And now, year over year, really very small pockets, except you can see the US Select dividends. So there is weakness everywhere. And that's, again, that's a conversation we're going to have. So as far as we're looking at the Bollinger Bands and what is happening with the SPX, I wanted to share this as far as we've added that CCI. We did have a class. So as you can see, CCI is more of the leader than, let's say, when we look at the stochastics and the MACD. So as you can see with the where we were, again, this is on the hindsight, but still it gives us a good indication of what to look for. So as you could see, once I look for the divergence, and once we cross that 100, minus 100 to 100, that's the zone we want to look at. And we look at like 200 and 100, and it's like we feel getting overbought. And then when it goes above 200, you just want to be aware. There's a momentum and strength, but just be aware of that. But now, once we cross that 100 and we cross the moving average, and this is from the thing, from a TradeStation, you see that was a good confirmation. And then, of course, we hit the 18-day moving average. And now where we are the opposite now. We are kind of look like an oversold, but we don't have any confirmation yet. And we will discuss a little more. So we might have a little divergence, as you can see. So we want to be aware of that. Once we cross that zero and we cross that moving average, maybe that's a good time combining it with the embedded, and if it moves to oversold in the stochastic, MACD will turn around. Most likely will be the third one, but at this time we want these Bollinger Bands flatten and start narrowing, and so for short term that might be an idea. So that's where we stand. So we have no confirmation at this time to go long. But again, the only thing will be the divergence. And I will discuss it again in our lesson of the week. What should we do in the short term and the long term? As far as on a weekly basis, looking at the Bollinger Bands, we have been under that 100 weekly moving average. If you recall, 6 weeks ago, we had a warning, and I said, listen, this doesn't bode well. We broke below the 100 week, and we had the second week. We tried to go, reverse it, but we just couldn't. And as you can see, again, the CCI, I am more of a believer of the CCI. I think works very well on a daily basis, and even like 60 minutes. If you're doing day trading on a 5 minutes, also works. The longer it goes, it's a little slower. So I would watch it like on a weekly. It's okay, but it's not as effective as on a daily basis, in my opinion. So, but still, you can see the momentum is down on a weekly basis, and we broke again below that 100-week moving average. You look at the NASDAQ, the same story. You can see again, we crossed it. It gave us the warning. We are flattening a little bit. So we had a little reversal on Friday, but we are embedded. MACD is down. We haven't crossed the -0. So I don't see much yet. As far as when we look at Russell, it is, you can see they're pretty similar patterns. The only thing is we have like lower low compared to SPX, which was a higher low on our CCI. But we are embedded. MACD is down. We have touched the Bollinger Bands, and Bollinger Bands are actually opening rather than closing. When we look at on a weekly basis on Russell, again, you can see momentum is down on the stochastic. So we've broken below that support. So basically the distribution continues. As far as the Dow, which again, that was down for the week also big time. It's very similar patterns as you see. So the suffrage is everywhere. It's not like you have the sector rotation that the things are moving, making one strength, which we used to have like with the financials moving to technology moving to financials. It's selling is in almost everything. It's very difficult to find a special sector that stands out. And energy was the only one, but of course last week was a bloodbath, but we'll discuss that also a little later. The transportation, again, similar, except we have a little higher high, but no confirmation. When we look at VIX, this is a question mark. And I mentioned last week what happened. We were like below. Now we are looking at these lows, very nasty sell-offs, and yet VIX is not even as high as it was. I mean, it should be above 40. That's what I talk about capitulation. We're still in a pretty reasonable, although we are high, granted, we are, it would be really like 32, 35. But we, first of all, we know once we hit the Bollinger Bands on Monday, we went outside of it. Look what happened. So we came inside. So it always, since the pandemic started, this has been a good indicator that every time we go outside, generally comes back in, except we've had, in the January, we had this big movement, and finally we came inside big time. It was a big short covering right there. But generally, it hasn't failed. So every time we go out, but the volatility is not as it should be. There's still, I feel, there's complacency. We talked about skew a couple of weeks ago, and still it's like at 120, 122. So there is not this, like, people are buying put options, for instance, and you can see that. And now you see a little divergence, or even VIX is telling us, even this above the moving average. What's going to happen? Is it going to go down? The momentum is down. And will that bode well for the markets? We're still above that 18-day moving average. So it is very confusing, actually, at this time. And we go to VVIX, which is the volatility of VIX. Of course, we hit the 100-day moving average and we got rejected. But this is not telling us a lot. So basically, when people are nervous, they're going to go buy puts. If they're really positive, they will go buy calls. So either way, what they will do with their purchases, they're going to push the implied volatility higher. By pushing the implied volatility higher, the VIX should really move up. Although we have moved from the lows that we were, but with the magnitude of the drop that we had last week, this should have been moving up very nicely. Look where we were in the past. And yet, we are way below where we were here, and yet this hasn't moved. So these are the concerns that I have. On the other hand, on a 10-year note, after the FOMC, as you can see, before that, we had gone up to the highest, and now we've had a little retracement. We are above the 18-day moving average, but the stochastic has gone to oversold. And also, we've had the crossing on the CCI, and we are crossing that 100. So basically, that bodes well for, let's see if it's like a technology or a NASDAQ this time, but we do have this big support here. So we want the confirmation. So as far as the rates go, we are not out of woods. And again, we have to separate the long term with the short term. Again, this is a 10-year, and the effects of it on the mortgage rates, where we are 6%. So basically, we want to watch that, and then we turn it around and look at the 10-year. You see that the resistance at 18-day moving average, although we are now oversold in stochastics, we did cross. That's good news. So the good news is we could have a few days of going back to that 18-day. Now, at that time, we have to have to wait and see. The question is the market really has priced in the older rate hikes? And that's what the markets are looking at, whether from the fixed income or the equities. So, but right now, from the technical side, we still have a little room to go, although volatility has expanded. On a 30-year, on a weekly, on the other hand, it doesn't look very healthy. We still have momentum down. So that's what I mentioned. It might be a short-term bounce going to that 18 days. So I will be aware of that. Um, as far as the 30-year bonds, similar, as you can see, similar uh, chart. And then financials. And of course, financials are, I think it's very important to watch the financials at this moment. Again, we talked about Walmart, we talked about Target, the effects of them in the economy. And I think I will follow with the JP Morgan. We want to watch Wells Fargo, Bank of America. Their earnings will be here in about 4 weeks or so. So those are the things they're going to give us a big clue as far as what is happening with our economy and what they see, especially based on, again, we look at um, the credit defaults and we look at the consumer behavior. So right now you can see the weakness in financials, and basically they are really, it's not just about the interest rates, but also the profitability and, again, what is happening with the consumers. So on the other hand, dollar, after 1 day drop, they came back up, but we are overbought, and you can see this is more of a neutral flat, so we wouldn't do anything at this time, but we are still have the strength in the dollar. And what happens with gold? Gold was, it's really interesting. Gold has the volatility is going into a squeeze. So basically, it is not a sell, not a buy. We'll talk about the gold trade, but it's pretty steady. You can see it has been pretty range bound. So I've mentioned it in the last few weeks. It's ready to make a move. That the consensus is the move could be to the high side, especially from the seasonality point of view, is coming up. So let's watch that. And the same thing is happening with silver. And then, first of all, okay, this is on that silver. We are looking at the similar idea of the Bollinger Bands. And again, we can see the CCI, but you can see how squeeze it is. And then when we look at copper, of course, again, this is, you can see how the CCI, first of all, it was above the 200. We pay attention after 200, we really stretching. The second thing was we had this 100-day moving average. Although, stochastic was up there, MACD was up, the trend was up. This was telling us just be aware. So once we turned around from that 200, and basically then we had the cross of at around 100, then you were getting your sell signals saying that, at least you don't have to short it, but be out of your positions in copper. And of course, again, this is a China story. What is happening? China is, the kids are not going to school in Beijing, and they're going district to districts, and we don't get all the information from China. So we really don't know what's happening there. So that has been a concern. And we will discuss that as far as, again, in the markets. And the Bitcoin, that's another, it's not a mystery. I mean, the thing was, everybody was thinking we're going to go to 100,000. Here we are. A lot of investors have never done really investing, and they're in different kinds of cryptocurrencies, from Bitcoin, they are to Dogecoin, to Shiba, they are Ethereum. So, but they all, long-term investors, and now with the big drops, and that 20,000 is pretty crucial. If we break through that, they haven't thrown their hats off. So once they do that, then we can easily go down to 10,000 if that happens. So right now, there is no confirmation. We were really oversold, but there's no confirmation of anything happening. We're getting a lower lows. There's a lot of nervousness. And one thing about Bitcoin, which was competing with gold and talking about dollar, it was supposed to be a diversifier. As you can see, it's the speculation. So that's the reason it's not responding. So basically, there was a couple other stories besides Elon Musk and what happened with You look at, let's say, Coinbase, what is happening, laying off their 18% of their employees. So anyway, these are the things you want to pay attention. And then crude oil. What happened with crude oil? We've had this big move, and then you can see again, the CCI gave us a heads up ahead of stochastics and MACD. You could see we were having a basically divergence here. And once we crossed the moving average and the 100, it was time. And basically, the question is, again, with the China story, and of course, after the higher interest rates, the question is recession. Is recession in the picture? With recession will be lower demands. So now, is this doing the job for the Fed by having lower, basically lower oil prices? Would that translate to lower gasoline prices? Unfortunately, because of what has happened with oil companies, as I said, they have not done a lot of investments in their structure. So it is still, this is something, it's a long-term problem. So although they're still profitable and they're doing well, I don't know if they will do any type of investments as far as developing, their technology. So this might not be a long-term, sell. It could go down, but even oil companies will be profitable at $60. So basically, this is really the fear of a slowing economy, which again, it's not bad for the consumer in some ways, because they can look for lower prices. And we mentioned, the energy price is the biggest thing on their mind. But then we look at weekly, you see that we're still above the 18 weeks moving average. So we haven't had a weekly sell signal, although we are oversold on a weekly, and we are crossing that 100 in CCI. I wanted to just show natural gas. So it's interesting, on exchanges, our futures in the United States, we had a huge drop on Friday, and there was, believe it or not, so one of the, there was a fire in one of the, these gas refineries, and they said that they will be could be up. It was in Madison or Mason, actually. They will be out till like September, but yet, the markets are, the futures in Europe is very much up because of what Russia is doing, stopping the supply. So they're up about 43%, and here we were down big time, 19% or so. So one of the things you notice, right, you can see the price, and then on the stochastics divergence, the same thing, which is interesting. Look at the CCI, the divergence. And once we broke below that moving average, and that was just giving us the heads up that something is happening. Again, you don't have to short, but if you have the position, these are good times to basically lighten up. So you got to be very proactive. And then you can see what has happened to energy sector. Again, you can see the heads up from the CCI, and basically in two different occasions. And now we just broke under the 100-day moving average. And when we go on a weekly, we have broken below that 18 weeks moving average. So we want to watch, again, that has become a big, it's playing a big role with the S&P. So be aware of that it can take that down. Last but not least, we've talked about corn. And again, this was the time a couple of weeks ago, we mentioned we got confirmations to, we are right at 100-day moving average. And it has continued going up. So it has been a nice trade. Although, the volatility is average, we are hitting the top of the Bollinger Band. We are becoming overbought. So, and also on CCI, we are getting above the 100, but the momentum is still there. So it's time, just watch it. If you have a position, just manage it. So, but we don't have the sell signal yet. Expected move. Amazing week. We were supposed to be, the expected move was about 131. So one standard deviation, it would have been either 131 up, 131 down, and we were like a 2 standard deviation out. So, I mean, it was an unbelievable week, and we've had quite a few of those. So what is happening for next week, remember we have a 4-day week, so it's still about 130 points expected move for next week. The story goes the same thing for the NASDAQ. You can see we were way outside, the gamma squeeze has happened. And then the same thing happened with the Russell. The same thing happened with the Dow. I mean, we could not even go above this temporary. We could go above the lower edge of expected move. And on the bonds, we finally just finished inside the expected move. And the same thing goes to the gold. We had a nice Thursday, the day after the FOMC, and then, of course, the higher rates, it doesn't bode well for gold. We did break below the lower side of expected move. On the other hand, silver actually stayed within its expected move. And then financials, again, similar to other indices outside of expected move. And look at this energy. I mean, this is like at least three standard deviation. And that was a huge drop. All right. So let's talk a little bit about emerging markets. Again, they play a big role. And what I've done with emerging markets, we want to look at, as always, we want to look at how they perform. This is as a Wednesday. And look what's going on. I mean, you hardly see any more positive. And year to date, these positive returns are becoming less and less. I mean, Saudi Arabia, look at Argentina, look at Indonesia and Turkey. The question you have to ask yourself, these are based on current, I mean, they're domestic currency. They are not dollar translated. So basically Turkey's up 38% or 36.3%. But if you translate it to dollar, actually they're down. So that's, you want to make sure we're investing in companies, I mean, in countries that they also have a healthy currency. So, but the idea is you look at so many reds, and this is on Wednesday. And then the other thing I want to take a look at is what is happening to the interest rates. What we have as far as the current account balance, we can see that, and also the interest rate, we can see the highest interest rates, like for instance, we see Pakistan, we have Turkey, and we also have Brazil. We also have Russia is 9%. So one word of caution, you look at what Russia is doing with ruble. Ruble just collapsed right after the sanctions. That's really, besides Peru, ruble is the only one who has had the positive compared to a year ago. It's up 23.6%. It's at 58.5. So it's below where it was before the invasion, or stronger. So let's look at some of these global economies and the country, I mean, companies. And I want to look at 1 year performance, so exactly a year ago where we were, and do we find opportunities? And what we can see Alibaba is down almost 52%. General thing is, when you see they're green, majority of them, of course, in energy sector. So there's a lot of them in the energy or some in the healthcare. So AstraZeneca, and then few in financials. We also have the telephone, but generally they are in energy, but these are big drops. So we want to watch this. I would recommend, and we will discuss it in our lesson of the week, got to have a watch list and be ready. So what happened last week? Although it's the countries like Switzerland, England, and I mean UK and Japan are not, or Europe and Italy are not emerging markets. They do affect the emerging markets. So what happened besides the United States with the FOMC's decision to go 0.75, Thursday, the Swiss National Bank surprised the markets. They just came, it was like the middle of the night here, early morning actually. I saw that they actually increased their rates by 50 basis point, which was the highest since about 15 years ago. They're still at negative 0.25, but that was a big thing. And their concern is, of course, they want to combat the inflation as aggressively as possible. Again, since 2007, that was the highest. And they are really looking after, again, combating that inflation. Now, in UK, as you know, again, we go with our weekly schedule. The Bank of England, they raised, as it was expected, by 25 basis point, but they are very much, again, trying to be very forceful, the dangers of inflation, which is above 11%. On the other hand, Bank of Japan, what did they do? They affirmed that they want the rates around zero, which is negative actually 0.1%. So they are very much dedicated to creating inflation. So basically they kept what they want. If we raise interest rates, the economy will move into a negative direction. So that's the Kuroda, which are the bank governor. Last but not least, this was really interesting what was happening, the Italian and German bonds spread. It was the highest since May of 2020. So it went high. It was a big collapse, really. It was like 3.83% for the Italian bonds. And then their finance minister, I believe it comes back and says, oh, you know, the spread was at 2 is too much, 1.5 will be good. And the market rallied in Italy. So, but these are warning signs that, you know, countries like Italy, you know, with the aggressive and as far as not aggressive control, they could affect the euro. And Europe, as you know, they haven't even decided how fast they're going to combat. And with the, again, shortage of gas, the energy, the inflation is rampant, and the consumers, we have to be aware of them. So they are really very careful between recession and inflation. So they haven't been really aggressive, but Italy is that's one indication. The other thing I want to bring to your attention, we'll discuss it tomorrow, is about the elections in Colombia. Now, Colombia, we've talked about from the market valuation, you know, they've been attractive. They do have energy companies. We've talked about a couple of their companies, energy and banking. And we talked about this election coming up. This is going to be a generational election. Why? Because you have one independent. He was a mayor of Bogota, and that was Rodolfo Hernandez. And there is, you know, he wants to work on anti-corruption, but the economy plays a role. There is this establishment. So he's going against Gustavo Petro. He was a leftist senator. Now, this is historical because one party is attracting one candidate, really a younger generation. And the younger generation, they are really looking at basically the government, as far as, again, there's a pressure from the economic pressure, and they're looking at Gustavo Petro. And on the other hand, Rodolfo Hernandez is attracting because the other side of the coin, because these young generation parents, they went in 1980s, they went on the guerrilla fighting, 1990s, and the parents, they would never, ever bring themselves to vote for someone who was a leader of the guerrillas, who killed many, many people. There was terrorism. And so you have this big combat. And what is happening now, basically, this back and forth, they're neck and neck. Rodolfo Hernandez has the support of the third, you know, after these two, the third rank candidate. So basically, that is important for the future of Latin America. As you know, recently in Latin America, there's a lot more left-leaning or socialist presidents have been getting elected. So this is important, and it's a big one to watch, and then also affects the market. So I want to look at the composition of the Senate. You see the blue is more of a right-leaning, and left is more of the red is more of a left-leaning. So you see there's no majority. Now, neither one, it's like Rodolfo doesn't even have a party. He's independent. There's no parties in the Senate or the House. So this is the composition of what it is with the Colombian House and Senate. I thought this is a pretty important chart to look at. And the reason is I wanted to look at the real yields and what is happening. So as you know, we are lagging behind inflation. Of course, Fed was way behind it. But these are you can see the spreads between the interest rates and the inflation. So China and Brazil has been ahead of the curve a year and a few months ago. They started increasing their interest rates, and that's when interest rates are so high, but they've been active on that. So I thought to share this with you. Very few blue that they have a real actual interest rates, positive rates. So just a food for thought where these are all emerging economies. So where do we stand? So the other part, Turkey is playing an interesting role with what's happening with Russia and Ukraine. There's a lot of investments from Russia is actually happening in Turkey. And as I had mentioned before, there was a lot of Russian tourism going to Turkey. So that plays a role. But what we look at, again, Turkey's electricity generation is mainly fossil fuel. So they're importers, so they're finding actually more resources, even finding oil fields. But generally between oil, coal, and gas, you see the majority, that's like 81%, is this arena. They have 12% in hydro and 6% in the renewable. So just a food for thought, that where is that coming from? Now, the other part is the Ukraine. So we're looking at the Ukraine real GDP growth year over year, but for the first quarter, look where we stand. I mean, of course, because of the invasion, they dropped 19.3%, and that came on June 9th. The numbers came, and they're down 15.1% for the quarter. So this is the sharpest. And when was the last time we had this type of a drop? Of course, was again Russian related, the invasion, when it was the cessation, annexation of the Crimea. Crimea was, again, annexed. So the question is, going forward, how much worse could it get? So this first quarter, remember, it was invasion was end of February, so it doesn't take complete effect of the invasion. So what we have to look at, second quarter could be ugly. But going forward, the things could not be, or they might not get as bad. And the reason is, it looks like the concentration has been on the eastern side of Ukraine, and life is coming back in Kyiv, and basically people are getting to work. So there might be some adjustments. So just a food for thought. All right, so for next 10 or 15 minutes, I would like to concentrate, where are we at the markets? Is this a good time? Should we buy? Should we hold? Should we sell? Is it going to get worse? Short term, about the end of the year? How about next year, 5 years? So let's dive in. Before doing that, let's a couple of things. Let's look at the rates. These are the long-term monthly rates. You've seen my long-term trends. As you can see, that 2% was very important to me. As you recall, we broke through that easily. Look how fast we moved. And then that 3%, we've gone above that. Again, this is on a monthly, so the June is not over, but that's where we stand. So we are almost in that resistance. but we naturally we've broken above both trend lines. So interest rates, of course, they're going higher, and of course, it affects the mortgage rates and the borrowing rates and investment rates as far as um, for the companies. So this is a critical thing, and that's where we watch the yield. The second thing I want to also address, a while back, I talked about the relationship between NASDAQ and the Bitcoin. And you can say, I just want to visit it, like what happened last week. So this is NASDAQ, and this is the behavior of Bitcoin. So you can see, I go back to Bitcoin. Bitcoin was supposed to be diversifier, but Bitcoin is basically a speculative asset. So it's not really protecting you in ways. It's basically behaving like technology and oriented NASDAQ. And you can see, I just want to share that with you again so you can see what is happening. So let's talk about, have we hit the bottom yet? So let's approach it, number one, from on a weekly basis. And I'm looking at the Ichimoku cloud. So a few things we want to observe. Number one, we notice we went under the standard line and then the turning line. We went inside the cloud. And since then, we tried to bounce back, and just amazing how we just hit the top of, the bottom of the cloud, the bottom of the turning line, and got rejected. So you have to, when you're doing investing or trading, it is not exact science. There's an art involved, but you also have to trust indicators that you have. When you start doubting, then you want to look for more indicators, and you want to have like 50 indicators to confirm each other. You will not be able to really do any successful trading. So it's all about, you've got to have some type of a faith and belief, and just have tight stops. If you're wrong, which we all are, and I've mentioned to you, when I trade, I know 1 out of 3 I will be wrong. So once you accept that, you will be right 2 out of 3. And that's pretty good odds. So if you have your stop loss set, and this is in a long term, so we're talking about weekly, but on a hindsight, when you look at things, you see that, wait a minute, I'm getting confirmation here. Should I be cautious? Maybe I could lighten up. And then we look at the DMI. We see that the DMI negative tried. So there is a tug of war going on right here. And basically what is happening, you still don't have confirmation, but here you're getting some warnings. And here we started the DMI negative, crossed the positive. Now the direction is, each one is going strongly one way. And you see, although we had a bounce on from the cloud, which was good, we got rejected. And we still strongly, the red is above the blue, or the negative over positive. And then we can see the ADX, the trend is getting stronger and stronger. So the question is, at this moment, when I watched this, do I have enough conviction that we are at the bottom and I should go ahead and buy? So, clearly, at least on a weekly basis, we see there's a lot of strength on the negative side. So what else can we look at? We can see the lagging line is crossing the cloud, but also I did, as far as what we were looking at, the extension, and I was looking at, if we go from the high to recent low to the recent high, which is lower high, can we get the extensions to see project, where could we go? Again, this is as of April. So from this high to this low to this high, when you draw those, I think last week I went over this and I said, we are at that 100%. It's important to watch this. Now, should we go and blindly say, because in that 100%, we're going to have a bounce? We thought about a short bounce, which it did happen. But on a weekly basis, we still, we are below a very critical zones and everything you can think of. And guess where we are now? We went to that 138.2 zone. how, I mean, that's why, the Fibonacci numbers are respected that, easily. So the question is, will this be a support? What if it doesn't? Do we go to that 34, let's say 3,500? I mean, in the past, I've said that, that 3,800 was crucial, and we went through that. The 3,600 becomes a round number crucial. And, we are right above that. So is this the bottom? But you do need confirmations, and the pressure is to the downside. So I won't be a hero, but we'll discuss it, what else we can look at. The same thing on a daily basis. I did again the extension from the high to the most recent high, to most recent low, to the more recent lower high. And you see we are right at the 61.8, but we are below all the moving averages. We are looking at 8 and 21 and 50. So we have broken below the moving average. The extension, granted, okay, we might have a little bounce, but still we have resistance. And then the next one, when we look at the 100%, it gives you some kind of a target. So this is from the technical side of things. The other thing I want to look at that it's been, God, even in the 2008, we did not have like a week that we've had this past week, past 8 days, or the 6 trading days, or 5 trading days, 6 trading days. These are the ranges for the SPX from high to low. And we talk about expected moves. Remember, our expected moves were like 130. That's supposed to be for a whole week. This was the past Thursday, 130 points, the previous Thursday. Friday, 135, Monday, 143. Tuesday was 100. Wednesday, FOMC day, 120. And Thursday was 191 points. That's 504 points. And we are talking about 130 points expected move. So the markets like this, they're not settled. So be cautious. This is not time to become a hero, in my opinion, again, and just say, oh, they're cheap, let me go in, I'm going to buy, this, I'm going to buy the market. So this is, again, something about the volatility in a sense of the ranges, and that's indecision, basically. The other thing I want to look at is, like, for the week, we could see, of course, they're all red, so we had few greens, but the rest, all the big ones, Microsoft, Apple, Google, Amazon, and so they're all red, right? But the good news is, remember, the S&P was down almost 6%, 5.8. NASDAQ was down big. So our bank stars, or the big moss stocks, we can say Microsoft, Apple, Alphabet, Amazon. So it's like 3 A's. They were actually, or we can put Facebook if you like, it becomes a mom. They were actually, they did better than the market. So do we find values? So that's a food for thought. But then we look at the year to date. Now, year to date, look at what's happening. I mean, these are big drops. And what you can see is energy still strong. Look at healthcare, and basically then we have a little bit of an insurance. So, okay. So what about year over year? Where do we stand in the past 12 months? Can we find opportunities? And you can see Apple is, just a little bit, break even, but Amazon is down 39%. Now, the good news is Amazon did the split. So it gives you opportunities to play with Amazon. And as we mentioned, Alphabet is going to have their split in July. So these are things we want to watch. And again, the strength, healthcare, and energy, and some of the consumer defensive. And then let's go in internals. We can see we've been watching this advanced decline line. Now, as long as, these are the soldiers, we are going down. So as long as there is no divergence, and these are not stronger than the markets, and what we want to look at, we want to have a higher highs in the advanced decline line to confirm that the trend has changed. We don't see that yet. Now, I know there's a temptation because we have this idea of, oh, the fear of missing out. My God, do you remember, the stock was down, like Citibank was down to $1, or Bank America was down, Delta Airline was in pennies. All of those days, Ford was like $2. I missed a lot. I want to be a hero, go back in. I'm looking at Disney. I'm looking at, again, Tesla, or basically any type of a technology stocks. You look at how many average stocks are down about 48.9%. So there's a lot of stocks are beaten up. So we get that temptation. The question is, do we become calculated and selective, but yet be patient? And it's okay to be late and be too early and lose and stop out. So just a food for thought. So we still have that. I don't want to say that things cannot turn around, immediately, and I will discuss some of the factors could happen. Let's go even further and look at the stocks that they are below this S&P 500 stocks that they're below their 200 moving average, the ratio. There's only, above, there's only 12%. That means about 60 of 500 S&P stocks are above their 200. This is weakness. This is something that you might find opportunity. But then you go back and you see that, well, when we had the pandemic, there was only 3%. So the direction has been down. When we broke below the 50 days, you can see, but that doesn't mean we have stopped. We've had you can see there were few bounces, but they were short term. We've had the lower highs and lower lows. So till we get some kind of confirmation, I would not rush in at this time. We go back, I want to go back to 2002 to see where we stand. We are very close to some of these, so you can see the numbers and make your own judgment. And this is where the pandemic happened. So we are much closer to the bottom, of course. So if you're patient and you think you can maybe dollar cost average, gradually find quality stocks, that would be different than just go in and buy the markets. This is the 50-day I want to look at, and we have 2%. Out of 500, we have only 10 stocks. So I want to, again, compare. We can see it's like really getting nasty there. Could we go lower? Yes, but we are very much close on a 50 days. So that tells me on a short term, we might have a bounce. So how would I approach that? I'm looking at the sectors, and I see year to date, there's only one sector, energy, is up like maybe 50% or so, and now you're down up 20%. But look at everything else. Now, do we go say, oh, technology and consumer cyclicals have gotten killed, let's find something there? Or do you want to be defensive? The utilities or commodity oriented, basic materials, everything is down. So you get opportunities. The question is, how low is low? Another thing I want to look at is we look at the housing, the home construction ETF, and they really collapsed. So what does that tells us? The housing sector, which is a big part of the consumer discretionary, and it tells about the attitude of consumer and basically how they're willing to do things. And you see the contrast between the actual yields, the 10-year yield, and the performance of, in this case, ITB and construction. So that doesn't bode well from the economic side of things, the consumer confidence. So let's go to the fundamental side of things, and let's look at the Shiller PE ratio rather than just a regular PE ratio, which what Shiller does, it goes back, looks at the 10-year inflation adjusted earnings and basically adjusts it so it comes, it's as they call them PE10 or PE, Shiller's PE ratio. It's very interesting. We were at the high of what happened in the Black Tuesday, the 1929 crash, and we are nowhere where the high of the internet bubble is, but we are at 2839. For putting in perspective, the mean is at 1695, the median is at 1587, the minimum is 4.78 in 1920, and the high was, of course, in 1999 at 44. The question has been, well, it is the reason PE is up, it is justified because we've had a 0% interest rate, so the premiums are lower. But now with the higher interest rates, can we justify that, especially if it keeps going up? So from fundamental point of view, where would be a good place? If you notice, when it starts going down, it continues. It just doesn't stop. And when it's like pretty high, we need to have more valuation as far as adjustments. Even when we look at the actual just regular PE ratios, we are at 1857. There's a lot of talks about, again, major companies that they have really, the valuation is wonderful. The question is, how is the growth, and will they keep up with that to contract the PE? And in this case, again, we are at 1857. The median is at 1489. So, and how the earnings are going to be affected. So we are closer to the bottom in this than the regular than Shiller. So we are, again, much closer to the good valuation, but I will be patient. So the question I have is now, should I buy, hold, or sell? How do we make that decision? So there's a few things we have to look at. The inflation. Now, is inflation going to get better or worse? And the factors that will be involved. So I put down some of the ideas which will help to understand the inflation. So we will go through that. Interest rates, obviously, interest rates going higher. Does that help the corporations? Does that give confidence to the consumer? And it comes with the consumer's confidence. What about the job security? What about, would you buy big items? What about mortgages? Do we want to buy that, the house with the higher mortgage rates? How about retail sales? Do I have enough confidence to go buy things? And now, with all that in mind, what is the chances of the recession? Now, what we hear, especially again with the Chairman Powell was saying that they will be accepting, they think the unemployment could go as high as 4.1%, which is very good. And that's their target. So if they continue and to get to that point, they will be happy with that. The question is that realistic, or we will have higher unemployment, which will create the recession? But the thoughts in the markets are, if we had a recession, which, by the way, the recessions are very interesting because of all this, the two negative, supposedly from the academic point of view, you have two negative GDP quarters in a row. We might even be in a recession right now. If that's the case, the funny thing about recessions, nobody knows till it's over. So the thought is it will be a very shallow recession, and that's why it's okay for the Fed to be aggressive and go with as higher, as fast as it can. So, but that is a question, recession, how the consumer will be affected. But also on the other side is the China's lockdown. What is the catalyst? If things turn around in China and their exports have been going up, so watch those numbers and the opening of the economy, the supply chain, what will happen with that? And that will be positive for inflation as well as activity. So that is a catalyst. Ukraine is a catalyst. And we don't see a short-term solution, but if that comes to a conclusion, that could be a good catalyst. It will cap at least the energy side and, as far as the commodity prices and inflation. So we want to look at the positive and negative things. Going long term for next year, for instance, we talked about the second presidential year is a negative. We've been talking about this for past year or so. So we've had that expectations that the markets will go down, But the third year is usually the strongest year for the presidents. You know, the second, the midterm elections are done. There's like the re-election is coming up. So that's the positive. So think about that. So the opportunities will be there. As far as we are in June 17th. So a food for thought, June 18th, actually, food for thought. We get some rebalancing in some of the indexes. It's the second quarter, end of the quarter. Could we have a little window dressing? So maybe short term. There's a 4th of July weekend coming. So what you have to do, you have to balance those. And then what happens the next 6 months? So there's two schools of thoughts. Now, what happened, this has been not a very pretty picture. We're down like over 31% in NASDAQ year to date, over 20% and 22% in S&P year to date. The studies done, like Sam Stovall had done, you know, he used to be a great sector analyst. And what he's observed is that once we have a year which we were up 20%, and the next year we are down big time from the beginning of the year, usually the second half of the year is positive. But with all the elements that we are having, it's not going to be as positive. So the thought was we might even get to break even. So from that point of view, might be, you know, close to the bottom. On the other hand, when we have recession expectation and the markets are down, generally the bear markets take about 9 months, but then it could take as much as 15 months. So right now we're in the 6th month, so it might be September to December things to turn around, or October. So especially again the midterm elections coming. So what do we do? And can we ask ourselves, oh, you know, it's gone down so much, it can't go down anymore? And I've heard these, a lot of like, especially average retail investors coming up, oh, so-and-so so cheap, how could it go any lower? Well, I got news for you. If you are, you know, remember the internet bubble or even the financial crisis that we had, stocks kept going down and they kept going down. Especially, remember, internet bubble, some of these companies just went out of, many of them went out of business, but a lot of good ones. I mean, you think about Cisco and Dell Compute, I mean, a lot of technology computers, they just kept going down. So the question is, especially when there's institutional distribution, things don't stop. So don't think because something is cheap, it's value. So you have to be patient. So what can we do? And this is my recommendation. I mentioned it last week, and I mentioned that you want to be, got to decide you're a trader, investor, or you are a vacationer. Either just take time off for a couple of months, enjoy your time. If you have passion for the markets, these are great markets. This is the time, and I'm glad you're part of this. Educate yourself, because with the value of understanding that you have multi-assets. It's not just about stocks. You have complete different assets, and you have different strategies, for instance, in futures or options, which they can complement your core holdings. So with options, you're not directional. You can go, you know, you can go long, you can go short, you can be neutral, you can play the volatility. So look at these as opportunities rather than being captive and passive and thinking that I don't have any hope, you know, things are going down. What am I going to do? Should I sell it now and get out? No, use your core again. You know, we talked about last time, you know, in 10 years, things usually come back where they were. So if you have the patience, but use the opportunities to become maybe swing trader, or every week, if you notice, we do the trading idea of the week, have an inventory, have a watch list, keep those, especially if there are stocks that they have a very good relative strength in these markets. I would put them, and that's why I try to show every week, put them on your, you know, watch list. And if you feel it's, you know, it's a good time to go in, just gradually go in. It's okay, but don't go all in. Don't go, you know, right now, cash is a pretty good place to be if you have it, and just be a bargain hunter. and you will succeed. So that's my 6 cents. So continue with the markets. Well, obviously the talk is all about inflation. It's interesting how many similarities are in many ways, but there's some not as, things are a little different now, but it is like 1973 and 2022. As you know, the 70s were not very kind, and it was a commodity cycle. We had, obviously the gasoline shortage. You remember those lines, and the stock market collapse, 73, 74. And what is happening is when President Nixon, got gold, standards out, the free float of dollar. Then we had petrodollar, and then in 1973, Syria and Egypt decided to invade Israel. And when they invaded Israel, United States stayed back and did not do much. Of course, it's Vietnam, and that's going on. But eventually, there was, as far as Israel was really running low in ammunition and their itineraries, and so U.S. got involved, and they helped Israel. And because of that, there was a backlash from OPEC economies, and that's what the oil embargo happened, and the rest is history. And what happened, the central banks did not act. They kept thinking this is transitory, and then we had Burns was the central bank president, I believe, from 1970 to 1980. And then President Carter brings Paul Volcker. And of course, Paul Volcker, what he was doing, he actually, now we're talking about 75 basis point, he went aggressively. And that's what the thought is, that's the difference now. And then he was doing 2.5% at one time. They were up to 19%. So 18 or 19% Fed rate. So basically that cost President Carter because of this aggression, but it also helped. We had two recessions at the same time, maybe within a couple of years because of that, but then it cooled down the inflation, and then the rest, we had major bull markets happening. So that's a little history lesson for 1973. So let's look at where we stand compared to 1980. So this is the height of the 1983, I believe, or 1980. Yeah, 1980 to 1983. So you can see the double recession we've had. So this is where we are as far as the inflation. So we are looking at and say, well, we're not doing as bad as this. So that's, we've come a long way, but things could get worse. But if you take take the utility cost and gasoline and food at home and electricity, just look at these necessities that families need, we are not too far away from where we were in 1980. And that's not good news, because from that really part of the inflation, we are almost there, and it's affecting the pocketbook of average, average working person. I want to go one step further. In 1983, what they did, and they are good at it, they changed the CPI index, and that's when they started something called OER, which is the no owner's equivalent rent. Before 1983, all they did, they were looking at the housing prices. So if it was easy to manage based on the mortgages, and they were looking and say, okay, this housing price has gone up. Well, that's part of inflation. But that was not very accurate, because you have renters, the rent prices go up. And so what they suggested, they came with this, the non-owner's equivalent rent, saying that even that if you own the house, if you would have rented it, what would be the equivalency of that? And we can compare it every year. The question we have to ask is, if in the past, rather than looking at the simple CPI of what the mortgage, in basic, just a house price is, if they had changed it to what it is today, this is what would have happened. Or the opposite, this is the official CPUI reconstructed. And if we take that non-owner equivalent, so if you would have gone back the way that CPI was in the past, this is where we would be. So we are getting close, or the opposite would be if they had it in blue, and that's where we would be. So we are a lot closer to the high inflationary environment we were in 1970s and early 80s. So that's from the inflation. The next thing is, this is again from the John Burns, that he has independent consulting now. Number of households who can qualify for mortgages based on increase in the mortgage rates. So as mortgage rates go up, less and less people can qualify. So current rate is at 6.13%. And what has happened, we are down to about 35 million. I think we have lost about 14 million people who would qualify for mortgages from when we started just a month ago or so. I mean, from the beginning of the year to now, from beginning of the year, we were at like 3% to now, 14 million less people can actually qualify for mortgages. Now, is that good for economy? I think the markets are doing the job for the Fed, so Fed is not too bothered with it, because Fed would rather have recession than inflation, and at this time, so basically, I'm not bothered with the stock prices at this time. So that's interesting. Last but not least is, I put down this caution. This is a slide I made. We had it in January 24th. And I mentioned the best investment ideas and themes for 2022 and beyond. And I said the caution, talking about cryptocurrency. And I said, brokercrypto.com recently paid $700 million to rename the Staples Center in LA, called Crypto.com Arena. Back in 2002, the NFL New England Patriots called their home CMGI Field, and Baltimore M&T Bank Stadium was named PSI Net Stadium. Now, both of these companies are no longer around, so that was the dot-com bubble burst. So I was just giving you a heads up that sometimes you see some name all over. I mean, you turn the TV on, that's all you see, crypto.com. Sometimes that could be a top. So go back where Bitcoin was in January 24th and where it is now and where it has been after that. So did it go up? Did it go down? So these are just more of a sentiment, just educational things. All right, I'm taking a lot of your time. So as I mentioned, it's going to be a long one. So let me just quickly talk about trade of the week. Look at these gaps that we've had last week. And this is what happened on Wednesday with the FOMC. We talked about generally like the Tuesday before, sometimes the markets, you can buy it in the morning and then sell it the next day. That used to be a FOMC trade, but also, oops. You could do a 1, 2, 3 trade. This was more of after the like 11:30. So FOMC came around here. You could have also do 1, 2, but after 11:30, when the press, it looks like market really likes to hear from Fed chair and really get inside of it. So you could see it could have been a good trade, but we did fill right at 11:30. We filled that gap. We haven't filled Thursday's gap. Friday was, all over. So it was interesting. So just food for thought, watch those gaps. Gold trade, again, with the way gold has been very neutral. So I did, again, 5 contracts. But again, the reason I share this with you, I'm happy to put my targets. And again, you would say, well, be patient. Why didn't you put it out here? But, well, they hit it. My last one, I did it manually because I wasn't sure how the markets are going to react on Friday. Of course, after I sold, it went up again. So it could have been 150, 60%. But anyway, the next day you can see what happened. So sometimes on Thursday you just get your fill, but we are in a very neutral and as I mentioned with the gold, anything can happen. ETF of the week, I just want to look at for the year. This is exactly last 12 months. You can see gold is up a little bit, gold miners, of course, oil is up big time, but almost other ETFs, the inverse ETFs have done well. And again, energy, that's about it. So everything else is down big time. So for the last week, the best performer for the week, with the markets being down more than 5%, it was the S&P Biotech. It was flat. So if it's flat, that's good. But then you had this Regal up 52%, and Akero was up 31%. On the opposite side, as we mentioned about natural gas, the FCG was down 19%. And also the holdings of WNT and Sandridge, they were down 27, 26%. I think, again, China ETF was lower by 0.7%, but it was much better than the other ETFs or the sectors. So, and energy exploration and production was down 18.5%. Couple other things we talked about ITB. I want to show you the XHB, which is again the construction, home construction. You can see how we topped, and this is the CCI again. Look at the divergence. You see that we were stretched pretty much over 200. There is lower high, really lower high, and that was giving you warnings. And once we crossed that 100, didn't put the moving average here, but now where we are, this is very crucial. So because as the construction and discretionary goes, that will affect again the consumer sentiment and mentality. So we want to watch that. You're right at 200 weekly. This is 200 weekly. So let's watch that. That doesn't bode well. We are not completely oversold yet, because we can look. We could go down a lot lower, but we want a confirmation. So we like this to change if you want the consumer behavior change. Also, there was a question. This is the inverse bonds. It's a triple. And as the bonds go down, this will go up. It has performed very well. But you can see one of the suggestions is, Wednesday when FOMC comes out, hey, just be patient. Thursdays are a much better day to digest the news, and that markets give you a much better idea what's going to happen. And in this situation, we actually had a sell-off, bonds went up. We do have a gap, so we'll see if that works well. A learning lesson, we talked about it. Look at the gap between the 20-day and 200. Oh, I'm sorry, this is 50-day and 200. So every time we go away, I should have put 20 in here too. You see, every time we get away from these moving averages, we've talked about parent and child. We want to come close. At least the parent knows, oh, child is okay. So we want this contraction in the sense of coming close. And then if you want a little stability, then you can do your trades, okay? Because you can see how overbought where we were in CCI, and now we are below 100. So if you want to be really aggressive and play the bond market's inverse, or you think the rates are going to go up, this might be a good play, but be patient. You can see it can be very volatile because it's a triple, remember. The other thing is ARK. So if you want to be contrarian, and Cathie Woods keeps saying, the markets are at the bottom. The markets are at the bottom. So that might be one of the aggressive ways you can nibble in, maybe, because look where we are. We are down, I think, 60% year to date and 75% from the high of February of last year, 75% down. So, and again, you can look at the CCI. We are very close. Again, you can see a little divergence here. We are oversold. MACD, this is flat. You can see how the moving averages are flat. But look at the volatility band, and just opening up a little bit. We are way under 100. Again, this is something you can maybe a trading tool for you because it moves quite a bit. So as far as if you want to hold it for a month or so, it has it would be an idea. So you can go either way because you can play ETF like SARK, which is the short of Cathie Wood's ARK. Stock of the week, we've talked about BABA because of the valuation. So again, I want to check, talk about this was really good, but what we did, we broke above the 100. We did go outside the Bollinger Band. So that was the time, maybe lighten up a little bit because we came inside. The good news is we are above the 18. And Friday, we had a really nice move, especially because of the China's authorities, what was happening. And but momentum is down, MACD is crossing. So I would be careful. Again, I would not short it, but if you break through that, then there's a good chance we're going to go hit this low. So watch for this. Again, CCI is trying to tell us that we should have gotten out here or here, and but it is not hopeless thing. There is a good chance this could turn around and cross back up, and that's strength. If we could do that, and MACD did the same thing, and we passed the 50 on, like, then you can actually either nibble in more or you can stop selling. I mean, that's one thing. The other thing, again, Friday was a really good day for BABA, but that's why I want to pay attention for the 60 minutes. Look what happens with the LRC. This is the Hakinashi. You see we changed the color, MACD changed the color. So right outside the LRC, once we hit that, this was a really good day. If you were playing options or have been playing it, this might have been a good day to take some profits. So pay attention to the 60 minutes. All right, the next couple of minutes, we talk about, again, the squeeze candidates. I thought to go with S&P 500. You can review it yourself. There's some really interesting earnings coming up, so pay attention to that. I'd like to know what the Lennar and Lazy Boy have to offer on Tuesday. And then Winnebago, with the consumers' behavior, are they still doing, the traveling? Accenture, Rite Aid, and the medical side. FedEx is a biggie. BlackBerry used to be. I'd like to know Carnival and CarMax. Again, it's what is average household is thinking about traveling. So basically that's again, please read these. These are good information. So I've run really over my time, but Smith & Wesson is coming up. So Darden. Anyway, my apologies if I held you too long, but I thought it was important. So with that in mind, I'm gonna stop the recording and open up for questioning. Thank you so much.